Hi everyone, what's up? Welcome back to my tutorial channel. It's Danny here and today I'm going to talk about the cost of capital. So this video will cover the cost of capital without taxes, equity debt cost of capital, and the cost of capital with taxes and some practice. Let's begin with the cost of capital. The cost of capital for projects or the required return is RF plus beta times the risk premium of the market. Here RF is the risk-free rate, RM is the market return, beta is the beta of investment, the beta of this project. And in order to get a cost of capital, we need to first get the risk-free rate, RF, and we use the US Treasuries as the risk-free rate. However, the risk-free rate might vary from time to time, so we usually use the risk-free rate at maturity. The second thing we need to get is the beta. This is the beta of the project respect to the market portfolio. And the last thing is the risk premium. And in order to get the risk premium, there are two approaches. Now let's look at the two approaches in order to compute the risk premium. The first approach is said to be the historical approach. We basically take the average of the excess of market return over the risk-free rates over a historical period. The second approach is called the fundamental approach, and we have to make some assumption for dividend growth. The value of the market is the present value of the future dividends at the market rate. Here P0 is the value of the market. It is equal to the dividend over the market return subtract the growth at which the dividend is growing. Here DV1 is the dividend, the future dividend. RM is the market return. G is the growth rate at which DV1 is growing. And P0 is the value of the market. So the value of the market is the present value of the future dividend at the market rate. Now let's consider the cost of capital with equity and debt. If a project is financed with equity and debt, then the cost of capital of the project is called the unlevered cost of capital, or the assessed cost of capital, and notated as RU. The unlevered cost of capital, RU, here is the weighted average of the cost of capital for equity and for debt. Here E over E plus D is the proportion of equity in this project, and D over E plus D is the proportion of debt in this project. E is equity value, D is the debt value, RE is the cost of capital for equity, and RD is the debt cost of capital. And the unlevered beta of this project, beta use, is the weighted average of beta of equity and beta of debt. If the company has cash, then cash is negative debt. The company's enterprise value is a sum of equity and debt outstanding subtracts cash. Here net debt is equal to the net of debt subtract cash. However, cash is risk-free, therefore beta of cash should be 0, leading to the beta of net debt is not equal to beta of debt. Now we will consider the cost of capital for debt and equity when taxes get involved. The weighted average cost of capital of debt equity with taxes is notated as RWACC. WACC is weighted average cost of capital, and this cost is the weighted mean between the cost of capital for equity and for debt with taxes involved. So it is E over E plus D times RE plus D over E plus D times RD times 1 minus tau C. Remember, only when you have debt, you have to pay for taxes. So here we got tau C is the corporate tax rate. RE is equity cost of capital. RD is the debt cost of capital. E is equity value and D is the debt value. RWACC is the weighted average cost of capital, and tau C is the corporate tax rate. So that's it for this lesson. Now we are going to do some practice. However, please keep in mind that the following exercises are just some core examples. In order to have the best practice, please find and work on more exercises that relate to this topic. First problem. Firm XYZ has the following market value balance sheet. Asset value 200. Debt value is 75. Equity value is 125. Asset value 200. Firm value is 200. If investors expect a return of 7% on the debt, and the firm average cost of capital is 10.5% on projects that have the same risk as the firm's existing business, what is the expected return on firm XYZ's equity? Assume no taxes. So here we assume no taxes. So there's no tau C in this problem. Right. Let's write out the equation of the unleveled cost of capital. We got RACC, or actually we can use it RU. We can use it as RU. RACC is the average cost of capital. This is equal to E over E plus D times RE plus D over E plus D times RD. Here we have no taxes involved, so there's no factor of 1 minus tau C at the end of the second terms. Now we are going to substitute 7% into RD, 10.5% into RACC. The debt value here is 75, so E is 75, D is 75, and E is the equity value, which is 125. So we got 0.105, which is 10.5% of the average cost of capital, is equal to E over E plus D, so it's 125 over 200, times RE, RE is not given, plus 75 over 200 times 0.07, which is the debt return rate. So this is a basic equation, linear equation. So go ahead and solve for RE. We got RE is 0.126, that means 12.6%. So that's the first problem. Now problem number 2. A firm has an annual dividend yield of 7.5% and a constant dividend roll rate of 3% per year. It also has 5 years bonds outstanding that have an annual coupon rate of 8% and are selling at par. The firm has a 40% marginal tax rate and a debt to assets ratio of 0.3. Calculate the firm's after-tax weighted average cost of capital. Here we are going to treat the dividend as equity and bond as debt. So the dividend rate of 7.5% is actually the equity cost of capital, and 3%, not 3%, the 8% of the bond rate is the debt rate. So RWACC here, and remember that the debt to asset ratio is 0.3. So D over E plus D is 0.3 and E over D plus E is 0.7. And 40% marginal tax rate is the corporate tax rate. So tau C is 0.4. So we got 0.7 times RE, which is 0.075 plus 0.3 times 0.08 times 1 minus 0.4 is 0.05394. So 5.4 is the average cost of capital. Problem number 3, a project is financed with 75% debt and 25% equity. You are given the risk-free rate RF and the market risk premium of 0.06. Beta of equity is 1.5. Beta of debt is 0.1. Calculate the unlevered cost of capital and the unlevered beta of this project. So here, equity, we got RE is using the security market line, we got RE is equal to 0.04 is the risk-free rate, RF, plus beta E times the risk premium. So we got 0.04 plus 1.5 times 0.06. So the equity cost of capital is 0.13. And similar for cost of capital for debt, we got RD is equal to RF plus beta D times risk premium. So we got 0.04 plus 0.1 times 0.06, which is 0.046. And now the unlevered cost of capital RU is equal to 0.25 times 0.13 plus 0.75 times 0.046. Here there's no taxes involved. So we just use E over E plus D times RE plus D over E plus D times RD. And we got 0.067. That means the cost of capital, the unlevered cost of capital is 6.7%. And the unlevered beta of this project is 0.25 times 1.5 plus 0.75 times 0.1, which is 0.45. Problem number 4, a project is financed with $6 million equity and $5 million debt. The project has $1 million cash in hand. Given that the beta of equity is 1, beta of debt is 0.1, the risk-free rate is RF, which is 0.04, the market risk premium is 0.06, calculate the unlevered cost of capital. So here remember cash is negative debt. We got 6 million equity, 5 million debt, and 1 million cash in hand. So we got 60% equity, 50% debt, and 10% cash. And don't worry if the sum is 100% because we got 60% plus 50% subtract 10% is 100% because cash is negative debt. All right, now in order to find the unlevered cost of capital, we need to find RE, RD, and R cash. So here, the total investors is 6 plus 5 minus 1, which is $10 million because we got $1 cash in hand. The cost of capital are first RE using the cost of capital formula. We got RE is equal to RF plus beta E times risk premium of the market. So it's 0.04 plus 1 times 0.06, and we got 0.1 for RE. Now for RD, RD is RF plus beta D times risk premium. So we got 0.04 plus 0.1 times 0.06, and we got 0.046. And for cash, remember for cash is risk-free, so beta of cash is 0. So the cost of capital for cash should be exactly the risk-free rate, and it is 0.04. Now we find the average cost of capital, that is the unlevered cost of capital. We got 0.6 is the proportion of equity, because equity is 60%, times RE, which is 0.1, plus 0.5 times 0.046. 0.5 here is because 50% is debt, and 0.046 is RD. Subtract 0.1 times 0.04. Remember, cash is negative debt. That's why we had to subtract here. And the proportion of cash is 10% is 0.1. Times 0.04 is the cost of capital for cash, and we got 0.079. So the unlevered cost of capital for this project is 0.079. After finish this lesson, here is the target. We should understand the cost of capital of a project, know how to calculate the unlevered cost of capital, know how to calculate the unlevered beta project, know how to calculate the cost of capital with taxes. So that is it for today.